Good afternoon, everybody. Uneducated Economist here. So in this video, we are going to be talking about how it is that the mortgage rates are going to be moving up and not going to follow the Federal Reserve in interest rate adjustments. So if the Federal Reserve goes to cut rates, do not expect mortgage rates to fall. In fact, don't expect mortgage rates to follow anything that the Federal Reserve is doing with their interest rate adjustments, because mortgage rates are now working independently of the Federal Reserve and their interest rate adjustments. So when people look at the Federal Reserve as moving interest rates lower, they have a tendency to think that this is going to impact the credit cards, the car loans, and especially the mortgages that people take out. They think that they're going to be impacted the same way, that mortgage rates are going to come down when the Federal Reserve goes to cut rates. Nothing could be further from the truth. There was a time in which that when the Federal Reserve would lower rates, yes, we would see mortgage rates moving down. But that doesn't work like that anymore, and it hasn't for quite some time. Now, I didn't leave a link down in the description to the Federal Reserve charts, but ultimately, if you type in Fed funds rate and then type in the word FRED, Fred, after that, the Federal Reserve economic data, what you will find is a chart that shows the Fed funds rate in the direction of which it has been moving over the last, 20 years. Take that chart to a 10-year chart and then open up another screen and do the same thing for mortgage rates. Mortgage rates, FRED. Bring up these two charts, and what you are going to see is that the Fed funds rate had really bottomed out in December of 2021. It had been a little bit lower a few months earlier, but that was essentially the bottom, all right? Was in December of 2021. After that, the Fed funds rate, oh, I'm sorry, let me bring this up again. Until it was not December, it was February. Sorry, it was February of 2022 when the Fed funds rate had bottomed out. After that, they started moving up in March of 2022. That's when the Fed funds rate started to move. Now, if you go and you look at the fixed mortgage rates for 30-year loans, they started to move in December of 2021. That's when they bottomed out. Ultimately, the mortgage rate started to move months, literally months ahead of the Federal Reserve. So December of 2021, mortgage rates had bottomed out. By March of 2022, the mortgage rates had gone from low 3%, 3.05%, to upwards of 4%, right? So a whole percentage point had increased from December of 2021 to March of 2022. Now, during that same time period, the Federal Reserve hadn't moved at all, right? In December of 2021, they were at 0.08% on the Fed funds rate. And by March of 2022, when the mortgage rates had shot up over 4%, the Federal Reserve made their initial move. They started to move after the mortgage rates had already done their thing, already started. This is because of the forward guidance. It wasn't because the markets were acting independently. It was because of the forward guidance that was given by the Federal Reserve. They were promising that they were going to be raising interest rates. They had put that out there. They didn't say how much, but they said that they were definitely going to do it. Mortgage rates started to move independently of the Federal Reserve based on that forward guidance. Now, something else is interesting is that if you go and you look at that same chart again, and you go to the Fed funds rate as of August of 2024, right after that, they started to lower rates from August to September. That was when they made their first initial rate cut. Now we have to think, at the end of 2023, they were putting out forward guidance. They were saying we are going to cut in 2024. They didn't say how much, but the dot plot suggested 7 interest rate cuts. Again, this was at the end of 2023. This forward guidance was being announced. They didn't actually cut rates for another 6 months. Right? But at the end of 2023, massive attention brought to the dot plot. The statement on economic projections was pushing massive interest rate cuts going into 2024. Right? Now, go and take a look at that mortgage chart again. What was happening at the end of 2023? Mortgage rates were peaking out. November of 2023, mortgage rates were at 7.76%. That forward guidance was announced that the Federal Reserve was going to be cutting rates into 2024. Didn't know how much, being data dependent, right? Statement on economic projections. The dot plot had put all these interest rate cuts going into 2024. And what did you see happening with mortgage rates? Right after that statement, before the Fed moved. Remember, Fed hasn't moved they don't move for another 6 months, right? But mortgage rates instantly started to fall. By January of 2024, after this forward guidance was announced that they would be doing this massive interest rate cuts going into the future, even though they hadn't done it yet, we watched mortgage rates go from 7.79%, 7.76% in November of 2023. And just after the new year, before the Fed moved, 6 months before the Fed moved, interest rates had dropped almost a whole percentage point on mortgages. They went down to 6.62%. And in fact, they continued to fall. There was a little rise. They ticked up a little bit and then continued to fall after that all the way until September of 2024. In September of 2024, shortly after the Federal Reserve started cutting rates, that's when the mortgage rates bottomed out. All right. So mortgage rates bottomed out in September of 2024, shortly after the Federal Reserve had made their initial rate cut. Remember, they started in August of 2024. So the Fed cut rates in August of 2024. A few months later, mortgage rates had bottomed out. That's it. That's as far as they would go. They wouldn't go any farther down than that. And even though the Federal Reserve continued to keep interest rates or continued to cut rates into the future, mortgage rates started ticking up after that, right? September of 2024 is when they bottomed out at 6.8%. And now today, they're up over 7%. Right? And again, the Federal Reserve didn't raise rates, right? Not since they did the initial cutting back in August. What was it? The initial cut back in, September is when they made that first initial rate cut, right? In 2024, they went from 5.33 down to 5.13 on the Fed funds rate, the effective fund rate. And it was shortly after that mortgage rates started to move up in the opposite direction. This is so important because most people are looking at the Federal Reserve as being the entity that is either going to raise or lower mortgage rates. And that simply is not the case. The Federal Reserve goes to raise rates, they do it with an announcement that they are doing it, and the mortgages act ahead of time. Think about it, like mortgages went from their lows in December of 2021 and peaked out essentially in October of 2023, right? Where the Federal Reserve had essentially peaked out in August of 2023. All right? Mortgage rates continue to operate independently of the Federal Reserve. And I know a lot of people will be very argumentative of this particular topic, but it's ultimately the case when you just go and look at the evidence of it. When the Federal Reserve puts out forward guidance, the markets start to behave. And you can see that when the Federal Reserve put out the forward guidance about interest rate adjustments taking place, and the mortgages started to move ahead of that. This is how the Federal Reserve is conducting their monetary policy, is by using forward guidance, signaling, jawboning, and essentially what I like to refer to as credible threats. And you can see that within the charts. It's difficult it's difficult if you have taken in the belief that the Federal Reserve is 100% responsible for it. Then it becomes very clouded and hard to understand. But once you look at it differently, that the Federal Reserve is influencing the market's expectations and their perceptions of what it is that's happening out there, then you can see how it is that the markets are acting and behaving independently of the Federal Reserve. Mortgage rates shot up almost instantly. The Federal Reserve was quickly, but they were working incrementally, moving interest rates up. Right? But then you go and you look at the mortgage rates, and they shot up almost instantly. They went from, 3.5 to 7% in a matter of a year. Right? And as the Federal Reserve continued to raise rates, mortgages essentially had peaked out. This is important to internalize. I see a lot of people out there right now who are worried about the housing market, worried about the way it is that they are going to be able to afford a house going into the future, and ultimately everybody is stuck on the idea that interest rate adjustments is going to be somehow a magical, tool of the financial markets out there in order to provide people with more homes. I just don't see how that's possible. You have a certain amount of people out there, and you have a certain amount of homes, and that's a supply-demand issue, and there's nothing you can do with interest rate adjustments to bring a supply-demand imbalance back into equilibrium. It's not going to work like that. Now, can you create a situation in which that people could borrow money to then build homes with, and try and find that the increase in inventory from the amount of people out there who are borrowing money to build homes? Yes. Would that do it? Sure. I could see where lowering interest rates might be able to provide the people with a little bit better opportunity to construct a home. Do we see that happening? All right. Not at all. You see new home starts are falling. Home Depot is complaining about how their sales are lagging. Right? Let me put it in there. New housing starts. Fred chart right there. These Federal Reserve economic data charts, they're really good. I mean, you could look up just about anything you want and they have a chart on it. And I know a lot of people will use the excuse like, oh man, they're just making those numbers up, they're fake anyway. I mean, if you want to know what the monetary policy is and how that is that the Federal Reserve is going to be conducting monetary policy, well, then you have to look at the numbers that they are looking at. Whether they're right, wrong, or indifferent doesn't really matter. If you're trying to figure out what it is that they are going to do, then you have to look at what it is that they are looking at. So go and look at like new privately owned housing units started, right? And you're going to see that peaked out. Just take that chart back to like 5 years. That peaked out back in April of 2022. It fell over the last few years and is really sitting at the lowest that it's been since pretty much in the last 5 years. Right? There's been no rise to the new privately housing units started. There's no rise to that. It's plateaued out. If not, it's falling. How about permit issuance? It's probably going to show the same thing. By permit, yeah, the exact same thing, right? Take it back to a 5-year chart. It essentially peaked out back in 2022, January of 2022, and it's essentially at the same place that it was back in June of 2022. 2020. So yeah, it's basically in the same position it was in 5 years ago. No rise to this at all. And so without increasing, like ever increasing amounts of it, like if you plateau out, then you're not increasing the amount that's available. More people are being born every day. Now, granted, we have a declining population where you don't have as many people being born in this nation, but it doesn't take away from the fact that there is more people every single day wanting to buy a house. Okay. Every day that there's a lag in the amount of homes being sold is another day in increasing of people who are demanding a home. Just because they can't afford it and they have taken a step away from the market and are now standing on the sidelines doesn't mean that they are not in demand of a house. Because they are actively not demanding it doesn't mean that they don't have it in their mind that they would love to be in a house. That demand for homes, whether people are capable of buying it or not, is far bigger than anybody gives it credit for. All right. You're missing something here, though. I don't know what. All right, 2.7% rates, market crash, and runaway inflation. I don't think so. Low interest rates didn't create an inflationary scenario. I mean, we had zero interest rate policy for 10 years. We didn't find an inflation from that. So there's no reason to think that, lowering rates is going to create an inflationary scenario. There are also people dying that don't need that house. Well, yeah, and I think there's missing something there as well. A lot of people say, well, there's going to be the silver tsunami of all these older population of people who are going to be passing away, and then that house is going to be empty when they pass away. I don't think a lot of people take into consideration that we have ever increasing amounts of multi-generational families living together. I mean, you got the old folks, you got their adult children, and maybe even grandchildren living with them, and then once those people pass away, the grown adults or the children of those baby boomers or the silver tsunami people who are passing away, they need a place to live, and whether they stay in that house or go find another place to live, that's still going to be a demand. That's not going to increase the available homes, because if they're already living there, they're going to have to find some other place to live if they're not going to stay there. And I don't everybody seems to think, well, this silver tsunami is just going to all of a sudden open up all these homes in a flood of inventory. And I'm thinking, probably not. Like, that house is already spoken for. You know what I mean? All right. But why are yields rising when they did cut? The Fed is boxed in. No, basic economics, lowering rates causes inflation. Absolutely. Okay. That may be easy to say it outright, but then now you won't be able to explain what happened after the great financial crisis and the zero interest rate policy. So now basic economics tells you that if you lower interest rates, you're going to create an inflationary scenario, but yet 10 years have proven that that did not happen. Right? So now what are you going to do? You have to take into consideration the great financial crisis, zero interest rate policy, and the Federal Reserve failed to produce an inflationary scenario from it. So how are you going to explain that now with your basic economic theory, right? That if you lower interest rate, it causes inflation. That is very, very inaccurate. In fact, low interest rate environment, an interest rate that is close to zero, is actually a deflationary environment because of the return on capital investment doesn't keep up with the purchasing power, or doesn't beat the loss of purchasing power within the money. So ultimately, if you have a low return on capital investment, by the time you get that money back, the purchasing power will have lost. You have gone into negative on your purchasing power. That's a deflationary aspect to the economy. Low interest rates is a deflationary concept. Dr. Lacey Hunt goes into this deeply. He really understands this. Here's a good way to understand this. If that's confusing to you, think about high interest rates back in the early 80s If you had a rich uncle who passed away, left you with $1 million, and you took that $1 million and you lent it to the United States government back in the early 80s, you would have had a return of around 15%, right? That's like $150,000 a year for your $1 million investment with the United States Treasury. Today, you would get what was it, 4 point something? So you get a little over $40,000 a year with your $1 million investment with the U.S. government. So back in the early 80s, you would have had $150,000 for that same investment. That's a lot of money. You could go buy houses and cars and go on vacation and deploy that money back into investment and production and all kinds of stuff that could happen within the economy, right? And that's at an elevated interest rate. Now you have low interest rate, you get a $40,000 return on your $1 million investment. That's barely enough to cover your living expenses for a year. You're not going to be able to deploy all that money back into the economy. Right? Low interest rates is actually a deflationary concept. At first, like the initial shock to the system when you lower rates, that does have a little bit of inflationary power to it. Okay? But it's very short-lived and it's like a flash in the pan. It'll end quickly. All right, thank you so much to the Pluzzy Bear for the $5. Our bond and Japan's bond market are going to break. Maybe Japan's, but not the United States. I don't believe that. I don't believe the United States bond market will break. Okay. Fed rates are macro, commercial lending is local, regional. All right, I think you guys are thinking a debt spiral happens overnight. It doesn't. It's a process that will take 5 to 10 years and play out. That's insinuated by the Chief Budget Office. Is that what it is? And Heritage Foundation. I'll get deployed back just through loving necessities. Okay. All right, Greece broke. Yeah, but that's Greece. I knew I shouldn't have tried to smuggle Benny's parcel through. Yeah. Yeah, you got to be careful on when Benny says, here, can you carry this for me? Yeah. All right, you're right. Sound economic policies versus smoke and mirrors. They play in the back rooms. Doesn't stand a chance. The market manipulation they are able to slip by us is not easily comprehended. Do you think deflation will continue? Disinflation? Because I don't think we have deflation. I think we have disinflation, which is different from a deflationary environment. Like, no, I just don't believe that the Federal Reserve is going to be anywhere in their mind to allow a deflationary scenario to even start. Like, that is their worst nightmare in the entire world. So disinflation as of right now, so long as it's moderately above 2%, I think is the position in which that they are trying to go for. We're going to find out more about that when it comes to their statement, their statement on economic or not the statement on economic projections, their consensus statement. When that comes out here at the end of the summer, we'll find out a little bit more about it. But as of right now, moderately above 2% for some time is still what I believe the Federal Reserve is attempting to do. I know I'm moving back to my hometown. The prices where I was started getting crazy. My rent raised $800 this year. No thanks. I can get a townhouse in my hometown for $900 a month. All right, I can send super chat. Still trying to figure out. Will you do a video comparing milkshake theory to Mar-a-Lago Accord? Yeah, that's something that was kind of interesting. I saw your comment yesterday talking about that. And so that's kind of an interesting topic to try and put those two together and compare the milkshake theory to Mar-a-Lago Accord. Basically, like the Mar-a-Lago Accord. Okay. Is essentially trying to weaken the dollar to make it more competitive. If you weaken the dollar, if you weaken the currency, your exports, like if you're trying to export to foreign entities, it becomes easier, right? So if the dollar devalues, they can get more, they can buy more of your stuff. And so this is kind of the idea behind it, that if the dollar strengthens, then you can't sell as many things out there. Well, the milkshake theory says just that, right? That here you are flooded the world with all these dollars, but the moment that you start reeling in the dollars, you start creating a strengthening of dollars that is actually going to be punishing to the exporters of the United States. So these two kind of compete against each other. Now, I mean, we could sit there and probably talk about these two all day long and the impacts between the two of them. But I find it quite interesting on how it is that the Mar-a-Lago, right, Accord is an attempt to try and weaken the dollar. Like here, let me bring it up here real quick so I can just read from it. All right. So the Mar-a-Lago Accord. The idea drew inspiration from the 1985 Plaza Accord, with the term referencing both historic analogy, there we go, and a symbolic location. Donald Trump's Mar-a-Lago Club, which he acquired the same year that the Plaza Accord was signed. So kind of the idea behind it, let me see here, later proposes a fundamental shift in the global financial markets and international trade, attempting to retrofit economic theory onto Trump's tariff-first trade agenda. At its core is a flawed premise that the U.S. trade deficits are driven by foreign demand and reserve assets, an idea with little validation in a real-world capital flow dynamics. Markets are already responding to the U.S. withdrawal from international economic engagements in trade integration. Layered on top of this confidence shift, the framework would risk further undermining trust in the U.S. risk-free assets. Even if unofficial, these proposals can carry market consequences if executed, especially those measures like selective default. They could trigger a credibility shock that severely damages the United States standing as a financial safe haven. All right. The idea drew inspiration. Oh, we already read that part. Right. So, an idea to try and lower the trade deficit. I think that's like the easiest way to explain that. And that if you can create a higher demand for your products, right? If you import more than you export, then you have a trade deficit. If you can begin to export more stuff, you can shrink that trade deficit. If you stop buying as much stuff, you can shrink that trade deficit. So now this is essentially the idea behind it, is to try and shrink that trade deficit that is happening within the United States. The only problem with it is it's not going to work. Like, I mean, it can kind of work, but what it ultimately comes down to is pain and misery that the people have to experience with either working harder, producing more, selling that stuff out there to the world, right? Which sounds great, but unfortunately the flip side of that is you can't buy as much stuff. You have to, basically live without, lower your living expenses. And by doing that, you don't import as much foreign production that comes into the United States. So between these two, you can shrink the trade deficit. And although when you use the words and you say it outright, it sounds great, but the experience that the people get from it is very painful, as there's no greater experience than to increase your standard of living, and there's no more of a painful one. There's no more of a painful one, there we go, than to lower your living standard. Okay? And so that's ultimately what it comes down to. And since it hasn't happened yet, it's all hypothetical. Still getting an error when I try to send a super chat. Oh, bummer. Alright. I like goat cheese. I like goat cheese too. All right, Simon, why is debt path the Treasury is unsustainable? Couldn't it be arbitrarily high without it making any real difference? It's not like the world's demand for dollars has a clear limit. No, and I think that's the thing. There is a limit. Like there is so much, but there is no clear limit on what that is. Like, everything is cool. We can still issue out the US Treasuries and everything seems fine today, but then one day it's not, right? So the Fed knows, everybody knows that you're on an unsustainable debt path, just like take into consideration yourself. if your living expense is more than your income, then you have to use a credit card, right? So you get your income, you spend all your paycheck on your bills and everything, but then you have a little bit more bills that you use a credit card for. Well, everything is cool until the day that you can't use your credit card anymore, right? Or even worse, your bills exceed what it is that your credit card can even pay for. Okay? This is like the unsustainable debt path that the United States is on. Can you issue out, 5 credit cards and have just stacks of it and just keep spending? Sure. Like there's the capabilities of doing that. There are people out there who will continue to issue out a credit card even though you might have terrible credit and, the chances of you paying might be very slim. But there's people out there who will continue to do it until one day it doesn't happen anymore. Right? And then at that point, it's no longer sustainable. So you, like every single month, even though you're maxed out 5 credit cards, spending like crazy every month, right? You're still making, you're still living in the house, you're still eating food, the lights are still on, you're still making it, right? But then one day it doesn't happen anymore. And that's essentially what will happen to the US Treasuries at some point. But I don't see that. I don't see it taking place as of yet. I can see the elements of the possibilities being out there, but the reality is not. What time is it? Oh, I got to get going. If you go and you look at foreign holdings of U.S. Treasury debt right now, it's higher than it's ever been. I mean, there's been a little drop over the last few months, but it's at the peak. It's as high as it's ever been. So knowing that the demand for U.S. Treasuries is still quite elevated, that is essentially the globe willing to continue to give the United States a credit card, right? And as long as they're still willing to do it, then we're not unsustainable yet, right? The moment that they don't do that, now it's no longer sustainable. All right, see you guys. I got to go back to work. I know you don't watch other channels. Mark Moss has a good video on Mar-a-Lago Accord. Cool. Much of it went over my head. Laugh out loud. Maybe you would understand it. Yeah, I should really go listen to it. I like Mark Moss. He's a great dude. I've known him personally, so. All right, later, Simon. Defense. Okay, you guys are awesome. Thank you for being here. We got 324 people watching, 75 likes. Thank you so much for hitting that like button. Thank you for the $5 super chat, because you guys are always so very supportive of the channel, and I really appreciate all the support you have for the channel. Keeping this stuff going, keeping me independent of sponsorships, which is, very thankful on my part to you guys, because I don't like doing the sponsorships, and I think you guys appreciate the fact that I don't take sponsorships. And so super chats is how you can sponsor the channel by viewers doing it themselves, as opposed to having, some company that we don't really care about doing it. All right, Uneducated Economist, you guys let me know.